There are moments in markets when nothing looks broken until you realize the silence itself is the warning. The screens are calm, the anchors are relaxed, the language hasn't changed, stocks are doing their thing, analysts are still debating earnings, growth, and rates. But somewhere beneath all of that, a different signal is flashing. Not loudly, not urgently, just steadily. And if you know where to look, it's impossible to ignore. Because while most people are still focused on paper prices and polished narratives, something unusual is happening in the physical silver market. Not a gradual move, not a slow repricing, a sudden, uncomfortable jump that doesn't fit the official story. A jump that suggests this isn't just another metals rally, but a stress response. Here's the uncomfortable truth. Silver doesn't move like this unless something deeper has shifted. It's one of the most controlled, most managed, most misunderstood markets in the financial system. And yet, suddenly, the most common physical silver products are trading far above what the screen says they should be worth. Not because of hype, not because of memes, but because the market that actually delivers metal is sending a message the paper market can't suppress. That message is simple. Trust is being questioned. When confidence in institutions weakens even slightly, capital behaves differently. It stops optimizing for yield. It stops chasing narratives. It starts prioritizing certainty. And in a system built almost entirely on promises, certainty becomes expensive very quickly. That's why this moment matters. Because this isn't just about silver hitting a number. It's about why that number is being ignored by the people who actually need the metal. The disconnect you're seeing isn't random. It's structural. And once a structural disconnect appears, it doesn't resolve quietly. Before we go deeper, pause for a second and think about this and answer honestly in the comments. Because this question goes straight to the heart of what's happening. If physical silver is already trading far above the quoted price, do you believe the screen will eventually rise to meet reality? Or do you believe reality will be forced back down? Drop one word: catch up or snap back. And if you want analysis like this that focuses on mechanics instead of noise, make sure you're subscribed. Now let's slow this down and unpack what's actually going on. Most people think silver has one price. It doesn't. It has two. One price exists in a leveraged paper market where contracts are traded, rolled, and closed without metal ever moving. The other exists in a physical market where inventory has to be sourced, financed, transported, and delivered. Most of the time, those two prices move together closely enough that people forget they're different markets entirely. But they are different. And under stress, that difference becomes visible. Paper silver is efficient. It's liquid, it's scalable, and it's built on the assumption that delivery is rare. Physical silver is the opposite. It's slow, it's constrained, and it only works if supply chains hold. When demand spikes faster than supply can respond, the physical market doesn't negotiate, it reprices. That repricing is what you're seeing now. When the most liquid, most recognizable physical silver products suddenly move into triple digits, it's not a fluke. Dealers don't reprice inventory across the board unless replacement risk has changed. They don't raise premiums unless they're worried about what it will cost them to restock or whether they'll be able to restock at all. This is where people make a critical mistake. They assume premiums are just noise, a temporary inconvenience, something that will normalize. Sometimes that's true. But when premiums expand rapidly across multiple sellers at the same time, it's usually responding to something upstream, something structural, and that upstream pressure almost always traces back to confidence. Silver is a monetary metal whether the system wants to admit it or not. It doesn't just respond to inflation data or industrial demand. It responds to trust. Trust in currencies, trust in institutions, trust in the idea that the rules are stable and the referees are untouchable. When that trust wobbles, even briefly, silver reacts before most other assets do because it sits at the intersection of money and reality. You can't spin it. You can't smooth it with language. You either have it or you don't. That's why the current disconnect matters more than the price itself. Because when the physical market stops respecting the paper reference, it's effectively saying, this number no longer reflects risk. And once that happens, the repricing process doesn't care about technical indicators, sentiment surveys, or analyst notes. It cares about availability. Here's an analogy that makes this clear. Imagine a fuel shortage. The official posted price at the pump hasn't changed yet, but stations are running dry. Lines are forming. Some stations close. Others quietly raise prices. The posted price still exists, but it no longer describes the situation. The real price is whatever clears the remaining supply. That's where silver is moving. The quoted price still exists. But the market that actually hands over metal is operating under a different set of constraints. And when two markets operate under different constraints, they eventually diverge. Now here's the part that makes this moment especially important. This divergence didn't come out of nowhere. It's coinciding with rising scrutiny, louder questions, and a subtle but noticeable shift in how authority itself is perceived. When leadership at the very top of the monetary system becomes part of the conversation, even indirectly, the psychological foundation of the system weakens. And markets are psychological long before they are mathematical. This doesn't require collapse. It doesn't require scandal. It only requires uncertainty. Because uncertainty forces participants to ask a dangerous question. What if the guarantees I've been relying on aren't as solid as I thought? When that question enters the system, paper promises lose appeal. Tangible assets gain it. And silver, because it's still accessible compared to gold, becomes a pressure valve for that anxiety. This is why you're seeing behavior that doesn't line up with the usual playbook. It's why silver can rise aggressively even when traditional relationships suggest it shouldn't. It's why physical demand can overwhelm paper signals. And it's why dismissing this move as temporary misses the point entirely. The move isn't the story. The reason behind the move is. And that reason points to something bigger than a metals rally. It points to a market beginning to question whether the old assumptions still hold, whether independence is real, whether stability is guaranteed, whether paper claims deserve the same trust they used to. Once those questions start circulating quietly, informally, behind the scenes, price discovery changes character. It becomes faster, sharper, less forgiving. In the next phase of this story, the response won't come from retail buyers. It will come from the system itself, from exchanges, from liquidity managers, from rule makers who have dealt with this exact problem before and have a playbook they've used in past crises to regain control. Understanding that playbook is the difference between reacting to headlines and anticipating outcomes. And it starts with recognizing that when physical silver breaks away from paper pricing, it's not signaling a top. It's signaling stress. And stress always forces a response. When stress starts leaking out of a tightly controlled market, the first response is almost never honest price discovery. It's containment. The system doesn't ask, what is this asset really worth? It asks, how do we stop this signal from spreading? That's why the next phase of this story has very little to do with retail buyers or headlines and everything to do with how exchanges and large institutions react when a market they rely on for stability starts behaving independently. Because silver isn't just another commodity, it's a thermometer. And right now, it's reading hotter than the official numbers are willing to admit. Historically, when a metal like silver starts to decouple from its paper reference, the paper market doesn't immediately concede. Instead, it tries to reassert control. And it does that through mechanics most casual observers never pay attention to. Margin requirements, position limits, delivery rules, technical adjustments that sound boring but are designed to force behavior. This is where understanding the structure matters. Paper silver trades primarily through futures contracts. Those contracts are leveraged instruments. You don't need to put up the full value of the metal to control a large position, only a fraction. That leverage is what makes the market liquid, but it's also what makes it fragile under stress. When volatility rises or confidence drops, the exchange has a lever it can pull. It can demand more collateral. Raising margin requirements does one thing very effectively. It forces weaker participants to exit. Traders who are long silver futures suddenly need to post more cash to maintain their positions. Some can, many can't. And when they can't, they're forced to sell not because they changed their view, but because the rules changed. From the outside, it looks like a natural pullback. Prices dip, commentators declare the move over, skeptics feel vindicated, but underneath, something very different is happening. The paper market is shedding speculative leverage while the physical market remains tight. This is one of the most misunderstood dynamics in metals. A paper pullback does not automatically relieve physical stress. In fact, in many cases, it makes physical stress worse because it convinces some holders not to sell while encouraging new buyers who see the dip as an opportunity. The result is a paradox. The quoted price falls, but the real-world price stays elevated. That's how confidence fractures widen instead of heal. Now layer in another pressure point, delivery. Most futures contracts never result in metal changing hands. They're closed or rolled before delivery. That's by design. The system works smoothly as long as participants behave predictably. But when trust erodes, behavior changes. More participants start asking for delivery, not necessarily because they want to store metal, but because demanding delivery is the ultimate test of whether the paper market is fully backed. And this is where exchanges become very sensitive. Because if too many participants demand delivery at once, the exchange faces an uncomfortable reality. Paper claims exceed readily available supply. That doesn't mean the system is empty. It means the timing and liquidity assumptions break down. And when timing breaks down, confidence breaks with it. To prevent that, exchanges rely on rules. They can limit how many contracts any single entity can hold. They can cap delivery amounts. They can change settlement terms. All of these actions are framed as risk management. And technically, that's true. But functionally, they serve one purpose: to slow the conversion of paper into physical. This matters because every rule change sends a signal. When an exchange tightens rules during a rally, it's implicitly admitting stress. It's saying, this market needs help staying orderly. And while that might calm paper traders, it often does the opposite for physical buyers. Because physical buyers read those signals as confirmation that paper promises are becoming less reliable. So instead of calming demand, intervention can intensify it. This is why the physical premium becomes the real indicator, not the spot price. Premiums tell you how much extra people are willing to pay to bypass the paper system entirely. They're a vote of no confidence in leverage. And when premiums rise quickly and stay elevated, they're telling you that the market is no longer unified. Another critical layer here is psychology. Most people are trained to think in terms of price direction, up or down, bullish or bearish. But in moments like this, the more important question is not direction, it's trust. Do participants trust that the system will function smoothly under pressure? When the answer is yes, paper dominates. When the answer shifts toward maybe, physical demand increases. When it becomes no, paper becomes irrelevant. Silver sits right in the middle of that spectrum. It's small enough to feel stress early, but important enough to matter. That's why it often moves before larger monetary signals become obvious. There's also a timing mismatch that amplifies these moves. Physical supply cannot respond quickly. Mines can't ramp production overnight. Refiners can't instantly increase output. Mints can't mint faster than capacity allows. That rigidity means demand shocks express themselves through price, not volume. Paper markets, on the other hand, can expand instantly. Contracts can be created with a keystroke. That's efficient in calm periods, but destabilizing in crises. Because it allows a price to exist that doesn't reflect scarcity. The current divergence suggests that scarcity is reasserting itself. And that brings us to a subtle but crucial point. This isn't just about silver buyers. It's about what silver is telling you about the broader system. When physical metals outperform their paper references, it often coincides with a shift in how risk is perceived. Investors stop asking, what yields the most, and start asking, what survives disruption? That's a very different mindset. And once it spreads, it doesn't stay confined to one asset class. This is why central banks, treasuries, and large institutions watch metals closely, even when they pretend not to. Because metals don't just price inflation, they price confidence. A rising gold price can be dismissed. A volatile silver price can be mocked. But sustained physical stress is harder to explain away. It suggests that some participants are preparing for scenarios the official narrative doesn't acknowledge. Now here's where many people get complacent. They assume that because the system has managed past episodes, it will manage this one the same way. And that might be true, but managed doesn't mean painless. It doesn't mean prices return neatly to old ranges. It means volatility is redirected. Often, the result is a grinding process. Sharp rallies, sudden drops, confusing signals, and a constant tug-of-war between paper suppression and physical demand. That environment is hostile to casual participants, but extremely revealing to those paying attention. And here's the key insight. Once a market enters that phase, it rarely snaps back to normal quickly. The trust that was questioned doesn't magically reappear. It has to be rebuilt. And rebuilding trust takes time, consistency, and credibility. If those things are in short supply, the premium for certainty remains. So the question isn't whether silver will move up or down tomorrow. The question is whether the conditions that caused this divergence are temporary or structural. Because if they're structural, then what you're seeing now is not the climax of the story. It's the opening act. And the next act is where history becomes very relevant. Because this is not the first time silver has exposed stress in the system. There is a clear historical pattern for how authorities respond when metal prices start sending the wrong message, and understanding that pattern is critical if you want to anticipate what happens next instead of reacting after the fact. That historical context doesn't make the future predictable, but it makes it legible. And once you can read the playbook, the noise becomes much easier to ignore. That's exactly what we need to look at next. History doesn't repeat perfectly, but when it comes to silver, it rhymes with unsettling precision. Every time this metal starts behaving like a monetary signal instead of an industrial input, the same tension emerges between free price discovery and institutional control. And every time that tension rises, the response follows a familiar arc, one that tells you far more about the system than about silver itself. To understand where this path can lead, you have to look backward without nostalgia and without drama, not to cherry-pick extremes, but to understand incentives. Because incentives don't change, even when technology does. In previous episodes of Silver Stress, the problem was never that silver became valuable. The problem was that silver became revealing. It exposed leverage. It exposed mismatches between promises and inventory. It exposed how much stability depended on belief rather than balance sheets. When silver prices began accelerating in the past, the justification was always the same: speculation, manipulation, irrational behavior. The language was designed to frame the move as a temporary distortion, something that could be corrected by tightening rules and restoring order. And for a time, that approach worked. Prices pulled back. Confidence appeared to return, but the cost was hidden. Each intervention taught participants something new about the system's priorities. It taught them that price stability mattered more than transparency, that orderly markets mattered more than delivery, and that when pressure mounted, the rules could change. That lesson doesn't disappear, it accumulates. The more often markets witness intervention, the more quickly they anticipate it. And anticipation changes behavior. Participants front-run rule changes. They seek safety earlier. They move into assets that are harder to control. That's why today's environment feels different from a simple replay. In earlier eras, the silver market could be framed as a corner, a squeeze, or a speculative frenzy led by a small group. That framing made intervention politically and psychologically easier. The villains were identifiable. The narrative was clean. Now the demand is diffuse. It's not one actor or one ideology. It's a broad, quiet shift in how risk is being priced across portfolios. It's institutions hedging tail risk. It's individuals seeking insurance. It's a collective response to uncertainty, not a coordinated attack on the system. That matters because decentralized behavior is harder to stop. You can change rules for futures traders, you can raise margins, you can cap positions, but you can't legislate confidence back into existence, and you can't easily reverse a global preference for tangibility once it takes hold. Another layer making this moment more complex is the macro backdrop. Silver doesn't exist in isolation. It's influenced by currencies, rates, growth expectations, and geopolitical dynamics. And right now, many of those forces are moving in ways that challenge traditional models. For decades, markets relied on simple relationships: strong currency, weaker metals, rising rates, pressure on non-yielding assets. Those relationships weren't laws, they were tendencies. And tendencies break down when the underlying assumptions change. If rates rise because inflation is feared rather than controlled, metals can rise too. If currencies hold value in name but not in confidence, hard assets gain appeal. If liquidity tightens unevenly, stress shows up where leverage is highest. Silver sits at the intersection of all of these forces. It's used industrially, which ties it to growth. It's held monetarily, which ties it to trust. It's traded heavily on paper, which ties it to leverage. That combination makes it extremely sensitive to regime shifts. And regime shifts are rarely announced. They're felt. This is why technical signals alone are insufficient here. Overbought readings, momentum indicators, and historical resistance levels can matter in normal conditions. But when a market is responding to a credibility event, those tools lose explanatory power. They describe past behavior, not present motivation. When people buy silver because they're questioning the system, not chasing returns, the market behaves differently. Pullbacks become buying opportunities rather than exits. Volatility becomes a feature rather than a warning. This doesn't mean prices only go up. It means that declines are interpreted through a different lens. Instead of risk off, they become test of resolve. And that changes how supply and demand interact. Another critical factor is relative value. Silver doesn't move in isolation from gold. The relationship between the two often reveals shifts in sentiment. When silver begins to outperform gold, it signals a transition from caution to urgency. Gold is the asset of preservation. Silver is the asset of acceleration. That transition doesn't happen quietly. It's often accompanied by extreme narratives, both bullish and bearish, because it forces participants to confront uncomfortable possibilities. It asks whether the system is stable enough to warrant patience or fragile enough to warrant action. When that question becomes widespread, metals stop behaving like trades and start behaving like statements. At the same time, there's a supply reality that's often overlooked. Silver production is largely a byproduct of other mining activity. That means supply doesn't respond quickly to price. Even sharp increases don't immediately result in more metal. The pipeline is long, rigid, and capital-intensive. So when demand rises suddenly, price has to do the work. Even small shifts in preference can move silver hard, because the market is tight and supply can't respond quickly. It doesn't require mass panic, just a marginal reallocation from big players. Once larger money starts moving, everyone else notices, and that creates a self-reinforcing loop. Physical tightness raises confidence concerns. Confidence concerns increase physical demand, and paper markets try to dampen volatility, often pushing even more participants toward physical. The result isn't a clean trend. It's a spiral, and spirals are uncomfortable because they don't give neat entry-exit points. They force people to decide what they believe about the system, not just what they think happens tomorrow. So the goal here isn't a perfect prediction. It's a framework thinking in scenarios, not certainties. Markets don't resolve uncertainty by handing you a clear answer. They resolve it by stress testing assumptions. The key assumption being tested now is whether the system can take a hit to confidence without changing its behavior. From here, there are three broad paths. One path is normalization. Pressure eases, scrutiny fades, messaging stabilizes, liquidity improves, physical supply slowly restocks, premiums compress, and paper and physical prices realign. Even then, the episode leaves a memory. Participants remember how fast conditions shifted, so the next time uncertainty appears, the reaction will likely be quicker. Another path is managed volatility, the most common modern outcome. Authorities and exchanges don't remove stress, they redistribute it. Rules adjust, incentives shift, liquidity is guided, and price swings become sharp but contained. Silver doesn't necessarily explode higher or crash, it turns erratic. Rallies are followed by sudden pullbacks, headlines swing between hype and dismissal, and the environment punishes impatience while testing conviction. The third path is escalation, not necessarily catastrophe, just persistence. If confidence concerns remain unresolved and responses feel reactive, pressure doesn't disappear, it migrates. Premiums stay elevated even when paper prices dip, availability becomes uneven, certain products vanish for stretches, and pricing fragments across regions. The danger here isn't collapse in a dramatic sense, but loss of coordination, different parts of the market operating under different assumptions. In that world, metals stop behaving like trades and start behaving like insurance. Access matters more than the right price, and traditional valuation becomes less useful. These paths can overlap and alternate. The important skill isn't guessing the exact outcome, it's recognizing which one is unfolding by watching behavior, not headlines. Are premiums compressing naturally, or only after forced selling? Is inventory returning smoothly or sporadically? Are interventions restoring confidence, or just buying time? Are participants trading the move or accumulating for longer-term protection? Because in this context, silver isn't the story, it's the messenger. If trust were intact, paper and physical wouldn't diverge like this. If stability were unquestioned, intervention wouldn't be necessary. The fact these signals exist means something has shifted. It may not guarantee a crisis, but it does signal change, and change forces adaptation, whether that means reducing leverage, diversifying, or simply paying closer attention to the quiet signals before they get loud.